Hello everyone. Today we are going to do lecture 19 or video lecture 19 in which we will cover this lecture 19 that's uploaded in your eCampus. So lecture 19 will finish chapter 10. Lecture 18 we started off lecture 10 about money, the functions of money, what gives money values, and we looked at different types of money and like commodity money and fiat money. But in this chapter, we are going to look at other different aspects of money because it's a very important part of the economy, and we will finish chapter 10. So basically, in this chapter, we will be focusing on the demand and supply of money and the price set in the market for money. So the price for money is basically the interest rate. So if we go back and try to draw a graph, if you remember, we have quantity on this side and price on the y-axis, right? If we are drawing the demand and supply curve for money, the price will be is actually your interest rate. Okay, in case of money, if we are considering that this is the graph for money, then the price reflects your interest rate, and wherever the demand curve and the supply curve will intersect will determine your equilibrium interest rate in the market. Okay, but let's first try to look at the demand side of money. So the total demand for money can be divided into two types: transaction demand for money or asset demand for money. Okay, and when we add the transaction demand for money and the asset demand for money, we get the total demand for money. It can be described as the quantities of the money demanded. So basically we have to know that the total demand for money, so let's say the total demand for money, I'm sorry, let's do this. Total demand for money is equal to transaction demand for money plus your asset demand for money. And I will explain what each of these means, what transaction demand means and what asset demand for money means. But basically we have to know that the total demand for money is equal to the summation of the transaction demand for money and the asset demand for money. So let's start with the transaction demand for money. So what transaction demand for money means is the demand for money, the money that we demand as individuals, as consumers, the money that we demand in order to buy our day-to-day, or in order to spend in our day-to-day activities, or buy our daily and buy goods that are required for our daily needs. So that's transaction demand for money. So if I need money to buy gas, if I need money to buy grocery, if I need money to buy if I need money to pay my electricity bill, that's a transaction demand for money, because this money is needed in order to meet my daily requirements. Electricity, grocery, gas, it can be water bill, your trash bill, your rent. So these are all transaction demand for money. Okay, so whenever you need money for the daily in order to purchase goods and services for that's needed in your daily life, then that's referred to as transaction demand for money. Now one thing we have to remember is the transaction demand for money is not influenced by the interest rate. Okay, so if let's say the savings account, if the savings account is offering high interest rates, so if you keep your money in the savings accounts, you will get a very high savings interest rate. That interest rate does not affect your transaction demand for money, because that money you're going to spend anyways because it is needed for your daily lives. So what the interest rate is in the bank for your savings accounts does not affect your transaction demand for money. So this is important. So remember, transaction demand for money, the transaction demand for money not affected by interest rate. Okay, so this is important to remember, whereas the transaction demand for money is affected by your aggregate GDP, or the nominal GDP in the economy. So what it is seen is if the economy's GDP is going up, the transaction demand for money also goes up. If the economy's GDP is going down, then the transaction demand for economy or for money is going down. So what it means that if the GDP is increasing over the years, that means there is economic growth, then that means people will demand more money for their daily transactions that they need. Basically their daily needs will go up. That's why the demand for transaction demand for money will also go up, and it is not affected by interest rate. So basically in this slide, that's what we're saying. It is not affected by interest rate, but it is heavily influenced by the amount of the economic activity or the level of economic activity going on, or the level of GDP. If GDP is higher, we will keep more money in the checking accounts and not in the saving accounts. So when we keep money in the checking account, basically we will be using that money up quickly for our daily transactions, right? When we go to a grocery, we will probably spend money from our checking account and not from our saving accounts. So whenever the GDP is growing up, we will usually have more money in our checking accounts and vice versa. So since money is held in the checking account for a brief period of time and it is used for transaction, the transaction demand for money does not have an effect on interest rate. So again, this basically is dependent on the GDP level, not on the interest rate. And if that's the case, how do you think the curve will look like for transaction demand? The quantity is on the x-axis, on the y-axis we have price or the interest rate. Now remember, we said the transaction demand for money is not impacted by interest rates. So no matter what the interest rate is, the quantity demanded for transaction will still remain the same because it depends on the GDP level. So in that case, the demand curve will be vertical, and we will write it as QDT, which is the quantity demanded for transaction money. Okay, so remember, the transaction money is a vertical line because the interest rate has no effect on your transaction demand for money. Now if GDP goes up, then your quantity, this curve will shift to the right and it will move to the right. If this goes down, then this curve will shift to the right because this is dependent on the GDP. So that's transaction demand for money, the money that we need for our daily transactions. Then we come on to the next one, the asset demand for money. So this is basically the money that we need in order to buy future assets, whether that is cars, whether that is homes, whether that is an investment in a business, or whether buy other types of stocks or bonds. Okay, so that's asset demand for money, the money that we demand in order to buy a home, in order to buy a car, or in order to buy other types of assets is called the asset demand for money. And for this type of demand for money, interest rate plays a very important role, right? Remember, just think, if the savings account, if the bank savings account is paying high interest rate, then we'll probably keep more money into the savings accounts and less money in the checking account because the savings interest rate is high. So I want to keep the money in the savings account, and if the interest rate is low, I will probably keep less money in the savings account and more in the checking account. So therefore, the asset demand for money is dependent on the interest rate, and it is sensitive to changes in the interest rate. So at low interest rate, people will hold more funds in the checking accounts. It does not make sense for them to keep it in the saving accounts because they're paying very low interest rates. So I will probably keep it in my checking account so I can use the money up. And the vice versa is also true. The concept of opportunity cost is actually applied when cash is held rather than invested on interest. So because if I'm not keeping my money in the savings account, I am foregoing the interest payment. If I kept it in the savings accounts, I could have earned an interest from there, right? But if I'm not keeping it there, then I am foregoing that interest payment, and therefore it is the opportunity cost of holding money in checking accounts. Okay, now let me do a quick example, and you decide what you will do. Let's say we have two scenarios, scene 1 and scene 2. Okay, under scene 1, savings interest rate is 10%. So if you keep money in the savings rate, you will get 10% return every year. For scene 2, let's say the interest rate is actually 2% only. Okay, so now let's say you have $100. And if you decide that you will not keep the $100 in the savings account, you have $100 and you decide that on the scene 1 you don't want to keep your money in the savings accounts and you want to use it up. So what is the opportunity cost? What is the income that you're giving up? You are giving up this 10% income, right? So basically the opportunity cost is equals to 100 times 10%, which is $10 every year, right? So that means if you decide and if you think that no, I don't want to keep my money in the savings account, I will rather keep it in my checking, or I will keep it as cash and use it up for transactions, in that case you are giving up an opportunity, or your opportunity cost is $10 per year, because you're giving up that income. You're no longer keeping that money in the savings account. On the other hand, if you look at the scenario where interest rate is 2% and you still have $100, now in this case, again, if you decide that you don't want to keep your money in the account, then the opportunity cost will be 100 times 2%, which is actually $2. So that's your opportunity cost. So look at this. In the scenario 1, your opportunity cost is higher. So you will probably in this scenario keep your $100 in savings, because your opportunity cost is higher, so you don't want to lose that income, so you want to make sure you earn that income. But in this case, the opportunity cost is low, so probably you will keep in checking account. Okay, so if your opportunity cost is low, then you will put the money in checking account. If your opportunity cost is high, then you will keep the money in the savings account, because you don't want to lose this income. And based on that, you can say that if interest rate is high, that means your demand for asset demand, or asset demand for money is higher. If interest rate is low, your asset demand for money is also, you will keep the money in the checking account, so you will probably not keep the money in the savings account. Okay, so based on that, the asset demand curve is actually downward sloping. This is again quantity, this is again interest rate. Okay, so that is the asset demand, QDA. This is the asset demand curve, and we know that we have another one called transaction demand, and it's a vertical line because it's not impacted by interest rate. Okay, and when we add these two, we get the total demand for money, which is actually a downward sloping curve, but it's less steep. Okay, and same, we have quantity here, we have interest rate here. Okay, so remember, the asset demand for curve is downward sloping, the transaction demand for curve for money is vertical, and when we add the asset demand for money and transaction demand for money, we get the total demand for money, which is a less steep curve. So hopefully this gives you an idea about the demand for money. There can be two types of demand. You need money for your daily transactions, and you need money to buy assets. So these are the two classifications of demand for money, and then based on that you get the total demand for money. Okay, so the equilibrium interest rate, so basically the equilibrium, or the market in which the interest rate is equilibrium, is determined when supply curve intersects the total demand curve for the money. And again, the supply of money is controlled by the Fed. The Federal Reserve is the one that will control the supply of money. So the supply curve will be a vertical line because they will determine how much money supply. Let's say they want $10 billion, so it will remain fixed no matter what the interest rate is. If they want to increase the money supply, the supply curve will shift to the left or to the right. If they want to decrease the money supply, the supply curve will shift to the left. So basically, we will have a graph. This is the demand curve and the supply curve is this, and this is the equilibrium interest rate. Okay, now if the Fed decides to increase the supply of money, then the supply curve will shift to the right and your equilibrium interest rate will actually go down, right? Because now from here we are moving to this point. So if they increase the supply, the interest rate will go down. On the other hand, if they decrease the supply, it will shift to the left and your equilibrium interest rate will go up. Okay, so that's how we find out the equilibrium interest rate in the market for money. One way they can solve disequilibrium in the market, let's say we don't have an equilibrium, supply is not equal to demand in case of money, and that's a disequilibrium. And if we have a disequilibrium in the market, it can be corrected. The government or the Fed can correct this problem by buying or selling financial assets. They can buy or sell bonds. The Fed, they can buy or sell bonds in order to bring equilibrium into the market. So if Fed buys bond from the public and the bank, then the money supply will increase. If the Fed sells bonds, money supply will decrease. And we will look into that in chapter 12 more details, but just to give you a brief idea, again, Fed buys and sell, or Fed can buy or sell bonds in the market to control the money supply. So if Fed buys bonds, think about this. Fed is buying bond from the general public and the banks. So what is happening? If they are buying, they are getting the bond, and in return they are paying money, and as they are paying money, the money supply is going up, and as money supply goes up, your interest rate will decline, right? So one comes with the another. Now think about the opposite direction. If Fed is selling bonds, to the general public or to the commercial banks, what's happening is the general public and the banks are holding the bonds, and in return they are paying to the Fed for the bonds, right? So the Feds will receive money in this case. So that's going out of the economy, and money supply is going down. As a result, the money supply curve will shift to the left and interest rate will increase. So this is very important. You have to remember this. This is one way they can control the money supply and control the interest rate in the industry or in the market. Okay, Fed can buy bonds which will increase money supply and decrease interest rate, or Fed can sell bonds which will decrease money supply and increase interest rate. Okay, so and one thing we have to determine, or we have to know from here, is that there is an inverse relationship or a negative relationship between the market interest rate and the price of the bonds. The bonds that the Feds are selling or buying, the price of that is inversely related to the market. This is because the bond interest payments are fixed for life. Okay, so what we have to remember is basically, this is important, it might be in your exam, is the price of bond has a negative relationship with the interest rate. Okay, and this is because of fixed interest payments. So you must recognize this relationship. And if I ask you in a multiple choice questions, or if I ask you in the homework, what type of relationship does the price of bond have or has with an interest rate, you will say it has a negative or inverse relationship. And why? Because it makes fixed interest payments. Okay, and I want to give you an example so that you understand this relationship. Okay, how you know, if how if interest rate goes up, the price of bond will decrease. If interest rates go down, the price of bonds will go up. So I want to give you an example and explain you this situation. Okay, so let me do the example. Let's say scenario one. Oh, let's say scene one. Okay, at first the bond is sold. Let's say bond is sold to the general public. Bond is sold at 5% yield or 5% return. So the person who's buying the bond will get a 5% return, and the price of bond in this case is $1,000. Okay, now let's say this return, this 5% return, this return will be fixed for 10 years. So for 10 years you will keep on earning 5% on the $1,000, or on the return. Okay, on the bond. So that's given to you. Now my question will be, let's say the market interest rate goes down to 4%. Now the market interest rate is going down. Before it was 5% return based on the market interest rate was 5%, so that's why we gave a 5% return. Now the market interest went down to 4%. So what will be the price of the bond? Okay, so that's my question. Now based on the relationship, the market price the market price of the bond and the market interest rate are negatively related. So here we saw a decrease in interest rate, and if as interest rate went down, so technically based on that relationship, we would say the price of bond will go up, right? It was $1,000. Probably now the price of bond should be more, because that's what the basis of the principle of says about the relationship between the price and the market rate. But there is a way we can calculate this, and here is the solution. And this will be a problem in your exam, so make sure you know this. So basically, this is important. I said your return will be fixed for 10 years, but this one is, let's say after 2 years, the market interest rate drops to 4%. So first you have to calculate your fixed payment. So what is the interest fixed amount you're getting every year? Every year you're getting 5% of $1,000 as interest payment, right? At the end of every year you have $1,000 is the price, and you get 5% of that, which is equals to $50. Okay, and this every year you will get $50 for 10 years. It is fixed because that's what I said, it will be fixed for 10 years. So every 50 year every 10 year every at the end of every year you will get $50. But now the market interest rate has changed, and this payment will also not change. So what will happen to the price of the bond? So now based on that we will have price. We don't know the price, new price, but we know 4% is the new interest rate, and our payment that we will be receiving is still $50. And based on that, the price of the bond after 2 years will be $12.50. We just did $50 divided by 4%, that gives us $12.50. Now that proves our hypothesis, or proves our relationship between price and bond, right? Before the bond before it was the market interest rate was 5% and the price of bond was $1,000. Price of market interest rate went down to 4%, so price went up to 1250. So here we can see there is a negative relationship between price of bond and the market interest rate, just because this payment remains fixed for life, or for here in this case 10 years. So after 2 years the price of bond will go up in order to make the adjustment so that you still get $50 per month. Okay, so that, I hope this example gives you a good understanding of the relationship between the bond market price and bond, on the price of the market, the price of the bond and the interest rate. Now let's look at the second scenario. Okay, so let's say same scenario. Initially the interest rate was 5%, price was $1,000, and payments were fixed for 10 years. Okay, now let's say after 2 years interest rate went up. This time, last time we saw it went down to 4%. Now let's say interest rate actually went up to 6%. What will be the price of the bond in this case, because payments are still fixed? So what will be the price of the bond after, what will be the price of the bond after 2 years? So based on the relationship between price and interest rate, we know they have a negative relationship. So now that the interest rate has gone up, most likely the price will be less than $1,000. It will probably go down. But let's do the calculation and see if it's actually true. Okay, again, we know when we bought it with $1,000 and the interest was 5%, so our fixed payment for 10 years is $50. It still remains the same, but now basically your interest rate has gone up, so we have to figure out the price times 6%, but the payment still remains the same, $50. So in this case the price will be equals to $833. This is definitely less than $1,000. This time the price of the bond has gone down because interest rates have gone up. So definitely based on this we can say price and interest rate, they have a negative relationship, and when interest rate goes up price of bond will fall, when interest rate go down price of bonds will go up. So the US banking system, and we will learn more about it in our video lecture 20, part 1 and part 2, because that talks about the commercial banking system. Basically started from the very beginning, but before the 1913 there was very little federal intervention. The federal government did not intervene into the banking system. There was not much regulation, and the states had their own banks that were doing their own banking transactions. Federal government was not very involved, but there were some national banks and they had the ability to make loans or not make loans depending whether they thought it was appropriate or not. But when recession hit, especially the couple of recessions happened, like in the Great Depression happened, it was found that banks um, recalled the loans for businesses and home loans. Although they were loans for 30 years or for 25 years, banks simply said, no, you have to pay me back right now. So that was not fair to the businesses or the home loans, right? Already they were in a bad situation because of the recession. And if the bank said, okay, now I want to recall my note, I don't want a 30-year note only. Whatever has happened, let's say 5 years have passed, I want my entire money back now. So as a result, lot of defaults began. Homeowners started to default, business owners started to default who took loans. So in response to this, federal government came into role, came into the scenario, and they started to develop role in the economy, and that's what led to the creation of the central bank, or also known as the Federal Reserve. So in the US, Fed Federal Reserve or central banks are used interchangeably. In the US, it's basically a dual banking systems. Both the state and the federal government has, both the state has banks. There are some state banks, local community banks, and there are some federal banks, such as they are nationally, like Bank of America, Wells Fargo, Chase. They are federal banks, okay? And there is maximum flexibility in the creation of new banks. It's very easy to create new banks now. Very little regulation from the government in order to create a bank. However, once you're created, the federal government will regulate your activities. So the Federal Reserve System or the central bank is half private and half public. Okay, so it's half government and half private. So we might think that the Federal Reserve is owned by the government, but that's not true. It's quasi-private and quasi-public, mean half government and half private. This is because private owners do have stocks in the Federal Reserve systems. You can invest and buy stocks of the Federal Reserve, so they basically have ownership in this type of in the central bank or in the Federal Reserve. But it's half government because they have to report their activities to the Congress, and it is mandated to operate in public interest. Basically, whatever they're doing, whenever they're increasing interest rate or decreasing money supply or increasing money supply, it needs to be reported to the Congress, and Congress will make sure they're doing it for the public. So whenever they are making any type of decisions, the Fed, they have to do it based on what is best for the general public. Okay, so within the banking system or within the Federal Reserve, there are different branches and there are different departments. So the first one is the Board of Governors. So the Board of Governors is the policy making institution, and they are responsible for the controlling the discount rate and reserve requirements. We are going to learn about these discount rate and reserve requirement in chapter 12. But basically, the Board of Governors is the main policy making institution, and they control the discount rate and reserve requirements. Okay, then there's another department called the Federal Open Market Committee. This is the one basically that carries out the buying and selling of bonds. What we just said, Fed buys bonds, Fed sells bonds to control the money supply, to control the interest rate. Just a little bit ago we talked about it. Fed buys bonds, that will cause the money supply to go down. Fed buys bond, that will cause the money supply to go up and interest rate to decrease, and vice versa. So this buying and selling of bonds and treasury securities is performed by the Federal Open Market Committee, and that's done to influence the money supply. Okay, another type of department that the Fed has is the Federal Advisory Council. It basically consists of some private citizens who gives advice to the Board of Governors. So the Federal Advisory Council, this is a group of private citizens. Then they act as advisors and they do research and say, hey, right now the market needs to have lower interest rate because we are probably going to hit recession. So maybe you need to increase the money supply and lower the interest rate. So they basically advise the Board of Governors who control the discount rate and reserve requirements. When we look at nationally, there are 12 Federal Reserve Bank. There is one in Dallas, so Texas has one of the Federal Reserve banks. So and these banks operate based on the regions. So maybe one bank, let's say there's one in California, they will divide into California, Oregon, Washington, and Nevada. Let's say we have Texas. This Texas Central Bank will focus on, let's say, Texas, Oklahoma, Louisiana, New Mexico. So that's how this is divided in the entire nation. Now we do have to know the specific functions of the Fed. Fed is a very important entity in the economy, and even now, when we are going through recessions, we see that the Fed is lowering the bank interest rates to zero. When banks are taking loans from the Fed, they are lowering it to zero. They're trying to increase the money supply, so they are taking a lot of actions in order to revive the economy. Okay, but basically the functions of Fed are, the first one is to issue currency. So basically they are the ones who will issue the dollar bills and the coins, and they will distribute those notes through the banks, through the commercial banks. and they also replace worn out currency. If something is is torn, they will replace it with new currency. Okay, then second one is they will control money supply, and as I said, one way they can do it is they can buy or sell bonds in order to control money supply. There are other ways they can control it, which we will learn in chapter 12, but for now just know they need to control money supply. They do the one of their function is to control money supply. The third function is they act as the banker's bank. What that means is, let's say Bank of America, like we have a checking account with Bank of America, Bank of America can also have a checking account with Fed. So basically Fed is a bank for Wells Fargo, for Chase, for Bank of America. They might have checking accounts with Fed, and basically they act as their bank. Then Fed also acts as a check clearing house. So let's say I have an account with Wells Fargo, but I get a check from Patrick, and he has an account with Bank of America. So when I deposit the Bank of America check in my Wells Fargo branch, the Fed will act as the clearing house. Basically, Fed will be the one who will be clearing the check. Okay, then it provides also banking services for the federal government, such as the IRS, the Department of Homeland Security, the Treasury Department. They can have checking accounts, and they can utilize other banking services for the from the Fed. And finally, they supervise all the commercial banks in accordance with law. They make sure that everyone is abiding by the laws and they are not exploiting the consumers. So that's one very important and final function of Federal Reserve. One last entity that we need to know and talk about is the FDIC in this chapter. This is again a half private and half public entity. Basically, private people have ownership in it, private citizens have ownership in it, as well as it is controlled by the government. But basically, it is an insurance program. So when we keep our money into the banks, in checking accounts into the banks, this FDIC will ensure that in case the bank collapses, we will get back our money that we have in the checking accounts. Okay, so it's kind of an insurance program for the banks. The banks do have to pay a premium to the FDIC. So every month they make a monthly payment, and in return the FDIC gives insurance on the checking accounts for each individual up to a limit of 250,000. So if your checking account has 300,000 and the bank collapses, FDIC will only pay up to 250,000. So for each account they will only cover up to 250,000. You probably have seen this, banks, they are saying, FDIC insured bank. So that's what it means. Probably now you understand what that means. It's an insurance program that protects the deposits of the checking accounts for consumers in banks. So that's the end of chapter 10 and the end of lecture 19. Next, in the next video lecture, I will start talking about commercial banks. Thank you, and I will get back to you with another lecture very soon. Bye.